Hey guys, I'm Big Mike, and like always, I'd like to thank you for being here today. Today we have Carley Garner back for a webinar on currency futures and options trading. Some of the bullet points that Carley wants to cover today is a look at currency trading, the simplified way to trade the futures market, comparison of Forex equity ETFs and futures, the truths and myths about currency market liquidity, the real transaction costs in currency trading, quoting and calculating in currencies, margins, currency options, and dollar cost averaging with e-micro future contracts. Sorry guys, I got really bad allergies, so bear with me. Carley has said that as you guys have questions, you can go ahead and type them into the questions box, and she'll stop and try to answer those as they come up. I do want to remind everybody that the webinar is being recorded, and I'll post the recording for this sometime tomorrow. All right, so with that, I'm going to go ahead and turn things over to Carley. All right, Carley, you should have the option to share your screen.
Okay, can everybody see the screen?
Yeah.
I'm gonna expand it here.
Okay.
So you can see everything. Just wanted to make sure I had hit the right button there.
Yeah, we got it.
Okay.
Thanks, Carley.
Yep, no problem. All right, thanks, Mike, for the introduction. It's a pleasure to be here. Okay, sorry it took a second for everything to jive here. Alrighty, so I guess we'll jump right in. Obviously, as Mike mentioned, we're talking about currency trading. We're talking about really what we're doing is we're kind of comparing the different venues. This isn't going to be like maybe some of the other classes that are hosted by Big Mike's. We aren't necessarily going to tell you what are the best indicators and different trading strategies, but what we are going to tell you is how to determine if you're going to trade currencies, maybe which venue to use, whether futures or Forex, and if you're going to trade currency options, maybe we'll give you some pointers on the same with the same question, which venue to use. And we're also going to talk about just a few tips and tricks on actual trading in the currency market. So maybe a little different than what you're used to, but trust me, I've been doing this a long time. I've been a commodity broker in March. It'll be a decade, so we're talking a good amount of time, and trust me, I've seen it all, and I can honestly tell you that much of the determination on whether or not you actually a lot of what actually determines whether or not you're going to make or lose money sorry, hold on, I'm not exactly sure what's going on here. Anyway, what determines on if you're going to make or lose money is a lot of it is really making all the decisions before you actually start trading. For example, which platforms, which brokerage firm, what your environment is. Because if your environment isn't right, your emotions are going to be probably not right as well. And so we're going to talk about some of those things. Anyway, let's get started. First and foremost, I want to make sure that everybody understands there's substantial risk of financial loss in trading futures and options, and Forex, of course. We're not investing, we're trading, we're trying to beat the markets. And there's a lot of smart people trading in the markets, and so for you to be a profitable trader, you have to be a little bit smarter than most of the others, and it sounds a lot easier than it actually is. My name's Carley Garner. I am a futures, options, and Forex broker. I work at DeCarley Trading in Las Vegas, Nevada. We are actually a division of the Zaner Group. If you happen to be on the social networks, Facebook or Twitter, check us out. You'll find us there. We post a lot of charts, commentary, events, things like that on the sites. And we also have a lot of educational material, free stuff on decarleytrading.com, so you can find some educational material there, as well as information on some of the things that we do and who we are. just to give you a little bit of a background on what I do, I am a broker. I write a couple of newsletters for my clients, usually daily, or if not, if it's a slow week, maybe we'll skip a day or so. But pretty often we write the financial futures report. It covers stock index futures and treasuries. And then we also give our clients trading recommendations, option selling ideas, things like that on the Carley perspective. And if you read Stocks and Commodities magazine, you may have seen me write a column in the magazine. It's called Futures for You. And if you're interested in anything that we talk about today and seeing things in a little more detail, you can check out my book, Currency Trading in the Forex and Futures Markets. It takes everything that we talk about today, plus a bunch more, but it just goes into so much more detail and will give you a much better idea of the big picture. If you're interested in commodity trading, A Trader's First Book on Commodities is a great place to start. As mentioned, I've been a broker for several years, and so what I did when I put this book together was basically try to answer all of the questions that everybody's ever asked me over the years, and trust me, there's a lot that goes into that. So, if you've been trading for years and years, obviously a beginning book may not necessarily be something that's high on your list, but I am pretty confident that you'd find something in there that would help you, because there's a lot of information that really isn't published anywhere else. Maybe people might not have thought of certain angles, but because I'm on this side of the business, I can see things that other people can't. And also maybe other people that are in my shoes maybe don't want clients or traders to know some of the things that I wrote in the book. So you might be interested. Kind of already went through this, so we'll skip the overview page. Right, first, I don't want to bore you, but I want to make sure that everybody here knows what we're talking about. So we're going to first cover some basics of currency futures and relate them to the Forex markets. Now, a lot of beginning traders come to me and they want to trade currencies, but they really just don't understand that there's actually two entirely different markets to trade currencies. You can trade them on the futures market, which is the CME, or the Chicago Mercantile Exchange, or you can trade them in Forex, which is the cash market exchange. Actually, I take that back. It's not an exchange. It's the cash market, and it's actually, the Forex market is really it's not a single market. It's like hundreds of mini markets that for some reason, someone decided to refer to them all as one market, and so we do. It's kind of like saying, if you say the stock market, you're usually talking about the U.S. stock market. You're not talking about the global stock market. But when people talk about Forex, they're talking about the global Forex market, and like I said, it's hundreds of little markets acting independently of each other. Although the prices all kind of follow each other, they're all tied, but it's not a centralized place where everybody's trading on the same network. It's a bunch of different networks. So anyway, currency futures. A currency futures contract is an agreement to make or take the delivery of the underlying asset at a specified date in the future. Now, most of you probably know this. So, for example, if you buy a euro contract today at about 132.5, or whatever the exact price is, you're agreeing to take delivery of the underlying currency at some point in the future, whenever that particular contract expires, at that price. This is the exact same concept in Forex, but the difference is the time horizon. Forex is a cash market, like I mentioned before. Forex contracts represent delivery in 2 days, whereas currency futures are quarterly delivery, and it's a set date. It's not a rolling calendar like it is in Forex. Currency traders are agreeing to the contract details, like I said, to buy at a specified price at a particular date at some point in March, June, September, or December. Unlike Forex, currency futures are highly regulated, and they have been for a very long time. And this is a big key. I want to give you a quick disclaimer here. We are capable of offering both futures and Forex to our clients. However, you'll notice as we go through this class, I'm I don't want to say highly biased, but that's probably the best explanation. I'm pretty biased towards futures, and I'm going to tell you a few reasons why. I'm not saying that nobody should ever trade Forex. That's absolutely not what I'm saying, because there's definitely some instances where the Forex market has a little more to offer than futures. But if you look at the big picture, in most scenarios, traders are typically better off trading currency futures, and I'll point out a few reasons why. Currency futures are traded on the CME group, as we mentioned before. The great thing and the important thing about this is the CME guarantees every transaction. If you buy a futures contract and somebody else sells it, it doesn't matter if the person that you sold it to can't live up to his end of the bargain. Let's say that his account goes negative, he loses more than he has on deposit, and he can't pay he can't pay the exchange to make up for the losses that he just sustained. To you, it doesn't matter. The CME guaranteed your side of the contract. So if you speculate correctly, it's real money. You made it. You're guaranteed that profit. And that sounds like a given, right? But in Forex, it's not necessarily a given. In Forex, you face counterparty risk. Now, the odds of your counterparty defaulting, usually the counterparty is your brokerage firm, or it might be a third-party bank or institution. The chances of them defaulting aren't big, granted, but you must know that it can happen. And in my view, it's almost like, why take the risk? If you know it's guaranteed in the futures market, why would you take the risk in the Forex market? In the currency futures markets, brokers never become part of the transaction. All the broker does is provide access to the market. They give you the platform, or they execute your trade, or whatever type of service level you're on. They give you access to the markets, but they're not trading against you. They want you to make money. They don't necessarily want you to lose money, because they don't benefit from that. The futures market is much more transparent, and the reason I say that, it's true. If you're a Forex trader, you can pull up any platform and you can see bids and asks and all those types of things. But like I mentioned, you're trading one particular piece of a network. You're trading on one little tiny market, and there's hundreds of other markets out there. In currency futures, it's one single conglomerate market. Everybody that's trading currency futures on the CME, it's all going to the same place. The bids and asks are all going to the same place, and everybody can see them. And also, what I was referring to is transparency in price, but sorry, it's more transparent in terms of transaction costs. We all know in Forex, they made a big, well, they built an industry on the idea that it's commission free. We'll talk about this a little later. Obviously, we know nothing in life is free. But in currency futures, people feel like they're paying more, even though they're not necessarily paying more. They just feel like they are, because they can see it. They look at their statement and they can actually see the transaction costs come out on their statement, whereas a Forex trader doesn't see anything, so they just assume they're not paying anything, which isn't necessarily the case.
Andreas has a question about volume. What is the daily volume of the Euro USD futures versus the cash market?
Okay, well, we'll talk about a little bit about that in a future slide, but I won't get into that specifics. But what I can tell you is there really is no way to know what the actual volume is in the cash market Forex, because it's not in one centralized location or one particular network. It's on hundreds of networks. So there's really no way to know what the cash market volume is. The CME does publish their volume figures each and every day. I mean, I'm looking today. It looks like on most days the Euro futures trade about 200,000 contracts. Each contract represents 100,000 worth of the current currency. And a lot of Forex traders look at that and they think, well, that's not very liquid. It's, that's nothing compared to Forex. And that's true, but like I mentioned before, if you're talking about Forex as in the global marketplace, that liquidity doesn't really exist for a trader, because if you're buying or selling on the Forex market, you're buying or selling in a little niche of that marketplace. You're not benefiting from the massive liquidity of the conglomerate.
Yeah, you're dealing with just your one bank, right?
Exactly. It might be one bank. Some, if you're depending on the firm you're with, sometimes you're trading against 4 or 5, maybe even 15 banks. But it's not, it's a little misleading. It's not the trillions and trillions of dollars that people think of. It's really not that. And if you're trading with a small Forex brokerage firm, it is very possible that you're trading against your broker and you really, there might only be 5 or 10 clients trading at that time. So you possibly might be trading in a very, very small and thin market.
Right.
You just don't know it.
David is asking, for day traders, what's the difference between the markets? For example, if he's closing out every day, what does it matter if a market is, 2 days or 3 months delivery?
That's a good question. Honestly, it doesn't. If you're closing out your position every day and just day trading, now if you've traded Forex enough, you know that there's rollovers and all those kinds of things and interests, costs going back and forth, but you eliminate all those types of things when you're day trading. The one thing I can say about that is the delivery doesn't matter to you. You're absolutely right. But what might matter is the margin. In Forex, and we'll talk about this a little later, but I just want to make sure I answer it now. In Forex, the day traders really don't get a margin break. The margin is it's actually a formula, and it fluctuates, but it's we'll just say hypothetically it's $4,000 for a certain currency pair. It's always going to be $4,000, whether or not you're in and out in 2 seconds or you're in and out in 2 weeks. It doesn't matter. Currency futures have a little bit different environment for day trading. Day trading margins can be as low as $500-600 on some of the currencies. Now, I'm not by any means encouraging anybody to use that kind of leverage. I'm just saying that it's available to currency traders where it's not available to Forex traders. So it's one thing to keep in mind, and we'll get into a little more detail on that on a future slide.
All right, one more question to get us caught up, and then I'll let you keep going. Raymond is asking, and I'm not exactly sure what he's asking, so I'm going to do my best here. I think he wants an example of the euro dollar and Canadian to Japanese yen on how the standard lot on the futures compares to the Forex side. I think he's talking about, like, my best guess is he's talking about the full-size futures versus the mini and micro.
Okay.
And what it is, like dollar per tick and pip.
Okay. Those are all great questions, and actually we do cover those in future slides.
Okay,
so
perfect.
Just for the sake of not being repetitive, I don't want to get into too much detail.
Sure.
But we will talk about how, like I said, there are some advantages to Forex, and one of the advantages is it's a little more flexible in terms of contract size. But the futures industry, or the CME specifically, is kind of counteracted with offering new products and things. So we're going to talk about all that kind of stuff and hopefully clarify that for you. All right, one of the biggest advantages, at least in my mind, of trading currency futures, well, I shouldn't say it's the biggest advantage, but it simplifies things the most, I should say, is the fact that everything is traded in American terms. Like if you look at Forex, it gets a little bit complicated because everything is kind of standardized, but some currencies are quoted in U.S. dollars, some are quoted in the foreign currency. For example, in Forex, if you're trading the yen, you're trading the dollar yen, which means the currency pair itself is actually priced in yen, not dollars. So when you trade it, you have to determine, how many pips you made or lost, and then you have to convert it to dollars to figure out what that really means. Well, in currency futures, everything's paired against the dollar. So everything is priced as it would be, like I said, in American terms, as if we're buying or selling another currency in dollars. So, for instance, if the Canadian dollar futures contracts at 95.16, it costs 95.16 cents to purchase 1 Canadian dollar. So for me, it's just a lot easier to get my mind around the value of another currency in dollar terms, as opposed to, trying to trade something in, like, for example, if you were trading the Canadian dollar versus the dollar in the Forex market as opposed to the futures market, it's the inverse. So you're actually trading an instrument that's priced in Canadian dollars, so your profit and loss is in Canadian dollars, and then you have to go and convert that back to US dollars to figure out how much you made or lost. So the futures market just simplifies things tremendously by pairing everything against the dollar, and takes a lot of the calculation and the guesswork out of it. makes my life a little bit easier. This is going to kind of answer the question that we just received a few minutes ago. In the futures market, there's standard contract sizes. Also, the tick values in the margin they're all standard size. They don't fluctuate. In Forex, the margin fluctuates with, if the euro gets a little more expensive, the margin goes up, and vice versa. The tick value fluctuates for anything in the Forex market that's not quoted in dollars. So like I mentioned before, the yen is actually, you're trading the dollar-yen pair, which is valued in yen. So a currency pair like that in the Forex market, the tick value changes as the exchange rate changes. So there's not a lot of easy math there. In futures, it's always going to be the same. The tick value is always the same, and so is the contract size. So in futures, the standard contract size unfortunately, I wish they would have just made all of the contract sizes 100,000. It would have made life a little easier. But some of them are 125,000. Some of them are 100,000. In the case of the British pound, which is kind of a strange one, it's even a little bit different. But we'll get to that in a minute. In the Forex markets, if you pull up a Forex platform, you actually have the choice. Well, it depends on the firm you're with. I mean, I know all of them are a little bit different, but you could trade 10,000 contracts, 20,000 contracts, 30,000. You could trade 120. You could pick, any random number, usually within a 10,000 increment on your contract size. In futures, it's not quite that simple. If you want to trade a full-size contract, you're automatically trading at least 100,000. You could also add a mini, which is half the size of that, or a micro, which is a tenth of the size of the full size. So in theory, you really could also customize your futures trading just like you could your Forex trading, but it's not nearly as convenient. In Forex, you use the same symbol. You just type in 130 instead of 100, and you're good to go. If you wanted to do 100,000 or 130 units in the Forex market, you'd have to do one standard size, which has one symbol, which is 6E, and then you'd have to do 3 micros. So, I mean, it's not as convenient, but it is possible. And the tick values, like I said, are always going to be the same because everything's always in dollar terms. No matter what happens to the euro, it's always going to be $12.50 per tick in the futures market. The Canadian dollar is always going to be $10 per tick, and the yen's always going to be $12.50. And in this slide, we go into just a little more detail. You'll notice that the British pound is kind of an outlier. It's 62,500 units, half the size of the euro, the yen, and the Swiss franc. I'm not sure why they do this. And just a quick warning, a lot of people assume because it's half the size, that means they can trade twice as many contracts, or maybe they think it's a little tamer, maybe it moves half as fast as the others, and that's not necessarily true. I've seen the British pound move, a couple hundred points in a single trading session, so it can really move. So don't let that smaller contract size fool you into thinking it's safer or anything like that, because it's not necessarily safer. One currency that I'm a big fan of that you will not see in Forex is the dollar index. The dollar index is actually, it's an index of all of the currencies versus the dollar. About 60% of the index is the euro, because if you think about it, it makes sense. Before the euro, there was several other smaller currencies, and once the euro was created, then they basically just engulfed 60% of the index. But when you buy or sell the dollar index, you're buying or selling the dollar against about 60% euro, and I think it's about maybe 10% yen, and so on and so forth. So you basically are trading the currency as a whole instead of against one particular currency. And like I said, you won't find anything like that in the Forex market. In Forex, it's very specific. You're trading one currency versus another, and there's nothing in between. So again, if you're trading a standard size futures contract, you're looking at 100,000 units for the Canadian dollar and the Aussie dollar. If you're trading the euro, yen, or the Swiss franc, it's 125,000 units. And I know this, it'll take a little, if you're a Forex trader, this takes a little getting used to. But keep in mind, the mini contracts are half of the full size. So if you're trading a mini euro, it's going to be 62.50. If you're trading an E-micro, which I'm a big fan of the E-micros, and I know a lot of people are probably thinking to themselves that that's just incredibly boring, but I'm going to kind of point something out to you that maybe you haven't thought of before, and so we're going to talk about that in a few slides down the road here. But the E-micros are 1/10 the size, so if you're trading an E-micro euro, you're trading 12,500 units.
Our Bach has a question that goes to the centralization aspect of the futures market.
Okay.
He's asking, are retailers, or I think he's talking about individual self-directed retail traders, are they directly related or routed to the CME data center in Aurora? Is there any smart route with HFT benefits? So I guess he's asking, first of all, maybe you should explain that any futures broker, it's all going to the same market. So does it matter?
Exactly.
As far as, yeah.
It's true. Like, if you're trading currency futures on the CME, so let's just take the euro for example with the symbol 6E. As long as you're trading that contract, no matter which brokerage firm you're using or which platform, it's all going to go to the same place. It's all going to be treated the same once it gets there as far as order queues and all that kind of stuff. You will find that a lot of platforms or brokerage firms, they will talk about low latency trading and that maybe they're closer, their trade server is a little closer to the CME server in Illinois, and so that'll shave 1/10 of a second off. I would say for most retail traders, it really doesn't matter whatsoever. I mean, if you're talking about 1/10 of a second in transaction time or less, maybe even, I mean, maybe the difference is 100th of a second. In my opinion, this is just my opinion, 99.9% of retail traders wouldn't know the difference anyway. The biggest delay they're going to have in their trading platform or brokerage firm is going to be how fast they can press the button on the mouse, not how fast the data actually gets there. Now, it's different if you're a lot smarter than I am and you're working with, you know how to program systems and you're high-frequency trading, maybe that's a whole different story. But for the average retail trader, honestly, I don't think the brokerage or platform is going to matter. It all goes to the same place, and it's executed immediately. So, right. I mean, unless the one exception I could actually throw in there is if which isn't dependent on your brokerage firm or your platform or anything like that. But if you have a slow internet connection, that can make a big difference. If we're talking a split second, I think it's inconsequential. If we're talking 3 or 4 seconds because you're on, Wi-Fi in the middle of the mountain, that can make a big difference. The market can move 3, 4, 5 ticks, and that's $50. And
right.
So that's something to. So in other words, be more aware of your environment and what you've done on your end to set everything up, as opposed to looking for a broker that's advertising the fastest connection speed, because I don't think that's going to matter in your results.
Yeah,
that's my opinion.
If you're an algo trader, then co-locate in Aurora, but if you're a discretionary trader, right, latency probably isn't going to make a difference.
I don't think so. Yeah.
Richard is asking, what's the unit size for the U.S. dollar index?
Okay, that's a great question, and I wish I actually have done in the past webinars for ICE, which is the exchange that lists the dollar index. We've done an entire webinar on the dollar index, so I wish I had a little more time. I could go into all the great things that contract has to offer. Because it's an index, it doesn't necessarily have a contract size. It's kind of like the S&P. There's no size, but there's a value. So, for example, right now the dollar is trading at 81. We'll just make it simplify it. It's trading at 81. Each full point in the dollar is worth $1,000. So the value of that contract right now is $81,000. So if you buy or sell the dollar index, you're essentially trading about $80,000 worth of the underlying asset. Obviously, it's an index, so if the dollar goes from 81 to 82, the contract value is now 82,000, and so on and so forth. But it's really something, if you've never traded the dollar index, you should really look into it. It's fabulous. The margin's low. It's about, it fluctuates, but it's approximately about $1,000 for margin. It doesn't move nearly as quickly as some of the others currencies, so it's a little tamer, especially for beginning traders or people like me that are just, maybe we're just wimps, I don't know. But for personality-wise, those that aren't necessarily big risk takers, it's a better way to trade the currency market. And maybe also it doesn't move as fast because it's diversified. It's kind of like trading, it's like the ETF of the currency market. It's diversified a little bit. You'll see times where, the euro's up big or the yen, but the yen's down big. It doesn't always happen that way. Usually the currencies versus the dollar move in the same direction, but it's certainly possible for them to move opposite directions in a short-term basis. And the dollar index kind of evens all of that out and smooths things out. And like I said, it's diversity.
Last question on the screen. TZ is asking about trading CFDs, contract for difference, and I don't know if it's worth mentioning or not. For all of us in the United States, that's not even legal. So again, that's kind of like the spot Forex world, right? There's no equivalent in the futures market.
Right. To be honest, I mean, because it's not something we do here. I'm definitely not an expert on the topic by any means. I would just throw out there, though, that any market that's not regulated and I'm not saying that the governments always have the answer, but at least at least if you're talking about a market that has rules and you're trading against other participants instead of your broker, which that's my understanding is most CFDs you're basically trading against your broker. I'm not a big fan of that because as a broker, I mean, I can imagine there's, I'm not saying that those types of environments always have negative implications, but the temptation's there. If you're a brokerage firm, you hear about it in Forex all the time. I'm not saying it happens, but it's certainly a possibility of, the broker spiking prices a little bit to run stops and things like that. So as a trader, even though maybe those things don't happen, maybe those are just people speculating on that, do you really want to, in the back of your mind, be thinking that every time you get stopped out? I don't. So.
Yeah, well, I mean, I'll just add a very small bit of perspective from my point of view. I mean, there's a lot of futures brokers, but by comparison, the number of spot Forex quote brokers is just astronomical, and I get so many requests, and they have all these affiliate programs. Like they would pay me $500 every single time somebody opens an account. That, which by the way, I never have anything to do with that, but that gives you just a little bit of an insight as to how fair or unfair it might be on some of those. So you really have to be careful and do your due diligence for sure.
That's a great point. And one thing that I don't really talk about just for the currency futures versus Forex debate could really be quite substantial. In fact, like I wrote a whole book on it. So what we're talking about today is kind of minor. But one thing to point out is a lot of the Forex brokers will pay you a rebate. And, it sounds great, right? If you get paid every time you trade, it's actually let me just put it this way. The Forex markets, they boomed in the last 10 years, and they've boomed for one reason and one reason only, because of marketing. They're genius marketers. They came up with commission-free trading. They came up with rebates. They came up with funding your account with credit cards. So all of these things that lure people into the markets that maybe wouldn't have gone before, it's been great for their bottom line. Is it great for speculators? The debate is still open. My opinion, you really have to be careful who you're doing business with. If somebody's offering you a rebate to trade, that means they're probably charging you too much in the first place. And it's genius on their part because they're paying you to trade, which means instead of trading 10,000 units, maybe you're going to trade 100,000 units because you feel like you're getting paid to trade. You'll probably be losing money in the markets, but in your mind, you're getting paid to trade. So, so it's genius marketing. That's really
especially if you're doing business
probably
with
not in your best interest.
Yeah, especially if you're doing business with one of the guys that's literally taking the other side of your trade.
Right.
So,
right.
Carly, I don't know if you have a slide that talks about the spreads or not, but you just mentioned commission-free trading. So do you want to talk about how that, I mean, it's not really free, it's just a different spread and how it relates in futures. Do you have a slide for that?
Right. We do touch on that briefly down the road, but it's definitely worth mentioning to make sure everybody understands it. commission-free trade. What happens when you buy, let's say that you buy the euro dollar in a Forex account. Your Forex broker immediately, like he sells it to you, he takes the other side, and then he immediately goes into a bigger network of banks where the spreads are tighter, and then he does the opposite. So he sold it to you, so he goes and buys it in the real market. I say real because it's a bigger, more liquid marketplace, but I don't know if that's the right word. But anyway, so he's offsetting his risk, so he doesn't have trade risk, but he makes money because you're paying, you know, whatever, just hypothetically, you're paying a 3-pip spread to get in and out, but he's only paying 1 pip in the quote-unquote real market. So that's how your broker's making money, is basically charging you a little extra than what the true market price is. So you are paying it, you just can't see it and you don't feel it. And again, it's just fabulous marketing. They did a great job at marketing the product, and that's really the bottom line.
And by comparison, on the CME, the spread is always the same. For many, it doesn't matter. Mm-hmm. Every broker is going to have identical spread.
Yep. Exactly. Yep. Exactly. The CME is centralized, whether you're Warren Buffett or you're some guy, you know, trading in your pajamas at home. The spread is 1 tick. So, you know, I tend to think it's a much more level playing field. And again, like I mentioned before, I think it's a lot more transparent because you can see everybody's orders, not just your brokers. Like if you're trading Forex against your broker, and there's different environments in Forex. You might, you know, so I'm not saying that all brokers are like that. But if you're trading against your broker, you are basically, he shows you the quotes, right? He's telling you where the market is, what the bid is, what the ask is, so you have nothing else to go on except what he's showing you. And there are some rules in place so that, you know, everything is on the up and up. But like I said before, you don't want in the back of your mind to be thinking, hey, did my broker just hose me on that when I was stopped out and then the market turned around? In the CME, I'm not saying you're never going to get stopped out at the low or the high, but at least you know it's real market action. That is what it is. It wasn't, you know, someone on the other end maybe doing, you know, hanky-panky. So.
Yeah, and I don't want to take forever on this, but just to make sure everybody totally understands, you can actually be a different low and high at each individual Forex bank because of the way the market works.
Yes, that's absolutely that's a good thing to point out. You could be stopped out at one broker where, like, let's say, for example, you had the exact same trade going on at 3 different Forex brokers. It's possible for you to be stopped out at one and not the other, or, you know, 2 and not one of the others. So it's not the equal centralized playing field that the futures market is. Okay. So my whole point is really currency futures are very simple, and calculating in currency futures are much more simple than they are in Forex. Again, the Canadian dollar is $10 per tick, and it's always going to be $10 per tick no matter what happens to the Canadian dollar, which isn't the case in Forex, because in Forex Canadian dollars are actually quoted in Canadian dollars, so you have to convert. But it's real easy. See, if the Canadian dollar drops 178 points, you made or lost $17.80. No conversion, just simple math. It's real easy. And I like easy. Maybe, I don't know, maybe I'm lazy, I'm not sure, but simple is good, right? Okay, one thing to keep in mind, and again, I'm saying currency Forex isn't all bad. There are some positive things in Forex, and sometimes, you know, clients might very well be better off having a currency futures account and maybe a Forex account so that they can kind of take advantage of the best of both worlds. But that's a personal choice. But anyway, the currency futures margin does tend to be a little higher than in Forex for overnight rates. So if you're a buy and hold trader, if you're buying a euro and you want to hang on to it for a couple days or a week or whatever it is, you're probably going to face slightly higher margin costs in the futures market than you do Forex. Now, keep in mind that Forex margin, like I mentioned before, changes really with every pip. The margin adjusts itself with every movement of the market. In Forex, it's pretty static. It doesn't change unless the CME changes it, and that really doesn't happen very often. I mean, maybe once a quarter, sometimes less, sometimes more. So this is all relative, but in general, you're probably going to pay more in the futures market to hold positions overnight. But I think, we mentioned this briefly before. Futures traders are granted deep discount margin rates by their brokerage firm for day trading. So if you're in and out in the same session, you're going to pay a heck of a lot less in margin in a currency futures account than you would a Forex account. Now, this is a big deal if you're scalping. If you're only looking to make 1, 2, 3, maybe 10 ticks a trade, whatever it is, you probably are going to be much better off in the futures market because you can do it with much less margin. And again, I'm just going to remind you, I'm not saying that everybody should trade super high leverage and do that sort of thing, but it's nice to know that it's there. If you get into a little trouble intraday in a Forex account, you're going to run into more trouble with the margin managers than you would in a futures account. And we kind of touched upon this a little bit, but we're going to make sure you understand the truths and the myths about currency market liquidity. It's often said that Forex, and again, Forex, not currency futures, is the deepest and most liquid marketplace in the world. Approximately, and this 4 trillion, this was 6-8 months ago. Maybe it's a little different now, but just bear in mind the overall point. Approximately 4 trillion is traded in the Forex markets per day. Participants can be large banks, central banks, institutionals, hedge funds, and now individual retail traders just like us. But Forex trading liquidity claims are a bit misleading. Again, most of the daily volume occurs in foreign exchange swaps, which are rollovers. So I mentioned before, currency in the Forex rolls over every 2 days because every contract that you buy or sell is deliverable in 2 days. Now, as a Forex trader, you probably don't know it. When you buy a euro dollar in your platform, you really don't see anything going on behind the scenes, but your Forex broker is continuously rolling that over and rolling that over for you so that you don't take delivery of the currency. That is what makes up most of the daily volume in Forex. So does that really add to market liquidity? No, because it happens at the end of the day. I think it's 5 o'clock New York time, and that's that. So yes, is there tons of liquidity? Yes. Does it benefit you? Probably not. Also, we mentioned before, but I'll say it again, those that are trading with dealing desks aren't benefiting from the liquidity that brought them to Forex in the first place because it's not a single market. It's hundreds of mini markets. And as Mike said before, there's a bunch of brokers out there. I mean, there's tons and tons of Forex brokers out there. Well, you can think of it this way. Each Forex broker represents an individual marketplace. So I've seen some really big Forex brokers and I've seen some really small ones. In some cases, when you're trading with a very small firm, it's very possible that you're only trading with a handful of people. You're seeing quotes and you think you're trading in a big market, but you're not. And somebody asked a question about liquidity earlier today, and I mentioned that on the CME they're trading somewhere around 200,000 euro futures contracts a day, and obviously that's not, I mean, it's a lot because each contract represents 100,000 worth of the underlying currency, and it is. That's a very liquid market. The bid-ask spreads that tick almost 24 hours a day. You're going to have no problems getting in and out. It's highly, highly liquid. But when you're talking about 4 trillion in Forex versus 200,000 contracts in the futures markets, on the surface people feel like it's far less liquid on the CME, and that's absolutely not the case. Liquidity is less about numbers and more about fill quality. And I would argue that your fill quality and the accountability, which is even more important, is better on the CME than it ever will be in Forex. All right, let's talk about the real transaction costs in currency trading, and we kind of touched on this as well. But before we get into much of that, let's kind of recognize that there's actually 2 ways that Forex brokers might generate revenue. And it depends on who you're trading with and what environment they're putting you in. And when I say environments, I mean who the liquidity partners are and so on and so forth. So the first way that they might generate revenue on your account is what's they call it a markup. And this is, again, Forex's, they're genius marketers because they know that people don't like to pay commission. So they didn't call it commission, they called it markup. That way people don't really understand what they're doing, right? And a markup is basically charged as a dollar amount per million units traded. A lot of brokers will charge $10 per million, which is approximately like $10 for a standard contract, or $1 for a mini is kind of how it works out. And a lot of you, if you are trading retail Forex accounts, you've probably maybe even never run into markup or this type of traditional commission being charged in a Forex account, and that's because it's only available on ECN networks, and ECN network is basically the quote-unquote real Forex market that I mentioned before, that's made up of several banks and institutions and things like that. Most retail traders have a hard time getting access to the ECN market, although it's a much truer marketplace. And the reason they have a hard time getting access is most brokers won't even give you that option unless you're trading 100,000 or more. Some of you might be familiar with PFG, who unfortunately was caught up in a big fraudulent scandal about 1.5 years ago. But they were one of the few Forex brokers that did offer ECN network trading to even the smaller clients. And knowing now what we know about PFG, now it's easier to understand why they were able to do that when nobody else could, because you know, they weren't necessarily operating in for profit margin. If you know the story, then you know what I'm talking about. Anyway, most Forex trading accounts generate revenue for the brokerage firm based on the pip spread. It's a hidden commission. So when you hear people talk about commission-free trading, it's totally bogus. It's all marketing. But they are paying to trade. Like I had mentioned a little earlier before, the brokerage firm will accept your trade and they'll execute it. So if you're buying the euro, they'll sell it to you, leaving you, so you're long, and then they will turn around and buy it in the interbank market, which is a bigger, truer market with tighter spreads. And that way they don't have any trade risk, but when you offset, they'll offset their position in the interbank market. And in the end, they come out ahead because they charged you 3 pips and they might have only paid a half a pip, or whatever the difference is. So if they tell you you're paying no commission, don't believe them. You are paying commission, and especially if they tell you they'll give you a rebate, that means they're making too much money on you in the first place, and they're giving you a little back.
A couple questions are up.
A lot of people assume that.
Sorry.
Yep, sure.
Stephen is asking, what's the reason for requotes on the FX market?
Really, requote, like, I know that if you're trading options, you can request for quote, and that's really because there's nobody else trading it. As far as the actual Forex contracts go, if you're requoting, a lot of times that'll happen in a fast market. You know, I don't know what the true issue is. Sometimes the Forex brokers' systems can't keep up with the fast market, you know, of the interbank market, things like that. Because you have to keep in mind, your Forex broker is basically showing you a synthetic market, is a good way to put it. Like, they're taking quotes from the interbank market, which I'm calling the real market just for lack of a better word, and they're using that to create a synthetic or a fake market for their clients. And sometimes, you know, if there's real, like, for example, non-farm payroll report or something like that, there's this, the trade just can't keep up. And so sometimes you get requotes where brokers, you know, I haven't really run into it, luckily, that often, but, you know, it is possible for brokers to requote, and I've heard of, you know, fills being changed and things like that, but unfortunately I haven't had much experience with it. So
last question, Arbach is asking if there is any type of like high frequency, low latency arbitrage between the CME and spot Forex markets.
I'm sure that there's some genius out there that's figured out how to do that, so I'm sure it exists. It's not, I'm not something that I've ever been privy to,
Yeah,
so
I think it's safe
I
to
wouldn't know
assume.
much about it. I would guess that it would be.
Yeah, I mean, if you throw up a chart of a big bank, a big spot forex bank, and then throw up a currency, a futures currency chart, on the CME, they will generally move in lockstep. One goes up one
Right.
tick, one goes down one tick. So there's definitely somebody there doing a little bit of arbitrage.
I would have to agree with that, yes. Is it me? No. Or anybody I know?
Not
Or
me either. Yeah.
do I know how to have access to that? No, but I'm sure it is done. There's a lot of smart computer programmers out there, so. Okay, is that all the questions?
And that's it for now.
Okay, for now. Okay. Alrighty. So don't assume that transaction costs are lower in the Forex market relative to the futures market, because they aren't. And in fact, you might actually be paying more in Forex than you would in futures. It really depends on your deal with your futures broker and things like that. But I would venture to say that it's comparable, or maybe even in some cases cheaper in the futures market, depending on what your rate is. Because if you think about it, if you're paying a 3-pip spread in the currency market, it's approximately $30. If you're trading in the futures market, you're probably paying less than $30 in commission if you're trading the outright futures and you're doing it online. So, again, there's a lot of ifs and a lot of room for differences here, but I would assume that it's probably even a little cheaper in futures than it is a lot of Forex arrangements. And I'll say it one more time, the Forex market or the Forex industry they were very smart and very good at marketing, because free commission really is the best way to get people to overtrade. And as a brokerage firm, it's unfortunate, but a lot of brokerage firms believe that they want their clients trading as much as possible, and that's how they want to make their money. They're not, in other words, they're not looking at the big picture in the long term. Unfortunately, a lot of brokerage firms want commission today, and that means their clients churning their own accounts, which it's very disappointing, because we all know that if you're overtrading, you're probably not going to last very long. You're probably going to blow out your account eventually, maybe in a day, maybe in a week, or maybe in a month, but it's not a long-term proposition. Okay, we'll brush upon futures margin versus Forex margin. We've already kind of discussed this. One thing to really be aware of is the Forex margin is dictated by regulators, or at least it is here in the U.S. If you're overseas, it's a whole different story. There really isn't anybody telling brokerage firms what to do. Here in the U.S., we have the NFA and the CFTC are just now, in the beginning of Forex, they really had no say whatsoever in what happened in the Forex markets. But at this time, they are getting a handle on things, and they actually limit the amount of leverage that Forex brokers can provide to U.S. clients. The current leverage ratio is 50-1. So futures brokers in the U.S. cannot offer more than 50-1 leverage. And as we mentioned before, Forex margin, if the dollar is the base currency in Forex, or you're trading cross pairs, margin must be converted back to the home currency, so it's a little more complicated. And another thing to know about Forex is the margin is actually measured and assessed around the clock. Margin calls are instantaneous. This is a lot different than in futures. In futures, margin's only really measured once a day, but in Forex, it's 24 hours a day. So for example, if your account dips below the margin level in the middle of the night, you immediately are on a margin call. If it dips below and bounces back, good for you, but you still probably had somebody give you a call or send you an email and kind of bust your chops about it. In futures, like I said, it's a little bit different. If dip into what would maybe be a margin call intraday in futures, but a market bounces back, you're not going to hear from anybody. It happens all the time. And in Forex, like we said before, there's no break for day traders. The margin is the margin whether you're holding for 1 second or 1 month or 1 year. The futures margin is static. It rarely changes. It's levied by the exchange, so regulators don't tell the exchanges or the brokers how much to charge their clients in margin. The exchanges set the margins, and it's measured once a day at the close. If you're trading the CME currencies, or actually even ICE, I believe is about the same, they close at 2 o'clock Central Time. Nope, I take it back. 4 o'clock Central Time. It's 2 o'clock my time, but 4 o'clock Central Time. So at that point of the day, the exchanges take a look at all the accounts, determine who's on or off margin call, and that's it. So what you do between then, well, I should say the market, it's kind of confusing because the futures market opens up in the afternoon and then it trades all the way around the clock to the next afternoon. So it's basically open 23 hours a day, just in a nutshell. What you do during that 23 hours a day is really between you and your brokerage firm. The exchange really only dictates what happens when they measure the margin at the close. So just remember, if you're trading futures, your broker sets the day trading margin, but the exchange sets the overnight margin. If you're trading Forex, regulators set it, or regulators tell your broker how to set it anyway. And I don't want to be too repetitive because we've kind of answered this already, but there's really 2 types of margin in the futures market. There's the overnight rate and then the day trading rate. The overnight rate consists of the initial and the maintenance margin requirements, which really only apply to traders that are holding positions overnight. And again, it's typically higher than FX. And some of you might be wondering what initial and maintenance are, and most of you probably already know. Initial margin is basically what you need to have in your account to put the trade on, and maintenance is what you need to have in your account to avoid a margin call once you have the trade on. Day trading margin rates are a little bit different. Futures day traders are often granted very low margin rates for positions, but that doesn't mean that you should use it. The odds of success are greatly diminished when leverage is abused. Now, I know a lot of brokerage firms out there that they offer $300 or $400 margins on the CME currencies, but what they won't tell you is, and I'm not saying any brokerage firm is good or bad. I'm just saying know what you're getting into and do your homework before you open an account. A lot of the firms that do advertise the super deep discount day trading margin rates, they'll let you into the trade with a very small amount of money on margin. But if you, for a split second, dip below their margin levels, their day trading margin levels, they'll just go ahead and blow your position out. They won't ask you, they won't email you or call you. They just say, whoop, he went over slightly, boom, he's gone. Or another thing they'll do is they'll tell you they only charge, whatever it is, $500 on a day trading rate for a certain market, whatever that market is. But then they'll say, but to open an account, you have to start with $30,000. So just be aware of the little marketing gimmicks and just know that some of these things that they're trying to sell you on are not in your best interest. Okay, we're going to talk about dollar cost averaging with e-microcurrency futures. Now, a lot of people just they look at the e-micros and they think, well, that's just a waste of time. Who the heck would trade those? And to be fair, the e-microcurrency futures are not nearly as liquid as the full-size contracts or anything you might see in the minis or anything like that. It's a newer product and it's still kind of catching on. However, although you don't see a big daily volume in the e-micros, you must know that the e-micros are tied to the full-size contract, and the price pretty much moves right along step with it. So even though it doesn't have the highest volume in the world, your fill quality is still pretty good. The market makers there are great. I've never had a situation where we're unable to get in or out of a trade or where we got a substantial amount of slippage. I mean, you will see a little more slippage on the e-micro than you would a full-size contract, but let's be realistic. the market maker is doing the best he can. And if you get slipped 2 ticks on a E-micro, it's like $2. So I don't think that's going to make or break anybody's trade. In this market, you're not scalping, it's usually position trading. The CME group launched the E-micro size futures basically in answer to the Forex market, which offered the micro lots, which attracted a lot of smaller traders, people that 10, 20 years ago you never would have heard of speculators in looking to trade currencies with 500 to 1,000 bucks. It just would never happen. But thanks to the Forex market that advertised the really small contract sizes and low margins, now it's something that the CME felt like they needed to match. And to be honest, I think it's I think they're great products. The margins range from 275 for the euro dollar to 182, and actually I think it's a little higher than this now. So I don't know what the exact margins are, but I mean, let's just say in the euro it's maybe 350 or 400, but even so, it's a great deal. And I don't think it's a waste of time, because what it does is it opens up the door for some strategies that maybe most of us couldn't afford to do before, and we'll kind of talk about that in a minute. Unlike the FX market, in which the pairs are standard in regards to which is the quote currency, the E-micro futures complex was created to make both Forex and futures traders comfortable. So remember before I said currency futures are very simple, they're all quoted in dollars, so there's no conversion or confusion. Well, that's true, but in the E-micros, the CME went a step further, and they actually offer the inverse pairs as well, so that if somebody that's used to trading Forex, they're used to trading the instead of the dollar yen, they want to trade the yen dollar, or vice versa. And in this case, I have an example of the Canadian dollar. Somebody that's used to trading the Canadian dollar, which is how it is in the CAD USD, that's how it would be in the normal futures market and the full-size futures, they can stick with that product. But somebody that's used to trading Forex and doesn't like to look at the inverse prices, and it throws them off a little bit, they can just trade the E-micro using the dollar CAD. So they can go both ways.
Yeah, I just looked real fast. The CME says that the for the micro 6E, initial is 275, maintenance is 250.
Oh, it is. Okay, so it is.
Sorry about that. Richard has Richard has a question also. He says, does the maintenance margin add to the initial margin or replace it?
Okay, good question. It actually doesn't do either. It just acts as a threshold. So I'm just going to use purely hypothetical numbers. Let's say the margin on any particular contract is 2,000. Usually the maintenance margin is about 30% below that. And basically the idea is if you wanted to trade that contract, you would at least have to have $2,000 in your account. But let's say they put the contract on and you lost 100 bucks, so your account is now 1,900. Even though you're below the margin level, you're not going to receive a margin call in the futures market. You wouldn't receive a margin call unless your account drops below the maintenance level, which we'll just say, for hypothetical sake, we'll just say it's $1,600. So you could lose as much as $400 on your trade before you'd ever get a margin call. And keep in mind that $1,600 threshold, which is your maintenance margin, is only valid at the close of trade. So if you lose, let's say you lose at some point intraday, you're down about 600, but by the time the market closes, you're only down 300. So your account is above the $1,600 maintenance. You're good to go. You're not going to receive a margin call. So the maintenance isn't something that's added or subtracted. It's just simply a threshold that's below the initial margin that triggers a margin call. Okay, microcurrency futures are a great way to enter a relatively low leveraged position in the currency markets. Now, I'm sure a lot of you have read the book Hot Commodities by Jim Rogers. And if you've read that book, you'll notice that he makes trading commodities or futures. He's mostly talking about corn and some of the other ag products like that. But he makes it sound very simple. Like, you just buy corn and you hang on to it for a little while. And you know why it sounds so simple to him? Because he's doing it with, he has a very large account to work with. He can buy corn and hang on to it for 3 years if he needs to. If corn doesn't go his way this week, he doesn't care. He'll buy a little more on a dip. And maybe 4 or 5 years down the road, he's profitable. That's how he trades. And for most retail traders, we just don't have the money to do that kind of trading. We don't have the wherewithal to withstand the ups and downs. We don't have the ability to add on if the market goes against us. But the e-micros really kind of level the playing field even for small traders, and it gives you the ability to do that kind of trading. There's a theory, and it is a theory, but commodities and currencies are the same way. They tend to trade in ranges. It's not like the stock market that historically has pretty much gone up forever. Currencies and commodities tend to be range bound. I mean, there's definitely extremes and troughs, but all in all, they really don't go anywhere, right? And it might take years for an entire cycle to play itself out, but they're still trading in a range. As a trading full-size futures contracts, it would take a pretty sizable account to do it, but in theory, if you had unlimited funds, you could really trade your way out of anything, right? If you could basically dollar cost average your position until the market finally turned around and you made some money. If you had unlimited funds, that would be possible. What e-micro futures does is it doesn't give you unlimited funds, obviously, but it allows retail traders with relatively moderate to small accounts to have that kind of mentality, that long-term mentality. You can put a position on in the euro currency, and if it doesn't go your favor this month, maybe it will next month, or maybe it will next year, but you can sit there and hold it. You will have to roll it over to the next contract month, but you're going to have some lasting power because the margin is so low. And if the market goes against you a little bit, you're not going to be so flustered and frustrated and scared that you exit. You might actually want to put another contract on and let it ride, and we'll kind of show an example of this in a minute.
Yeah, micros are good to cut your teeth on, is what I tell people. I mean, it doesn't matter if you're trading oil or currency or whatever. I mean, it's cheap enough, dollar per tick, that you can learn to get control of your psychological issues and so forth at a very inexpensive cost.
Yes, absolutely. I'm glad you brought that up. And I tell people this. I'm not a big fan of paper trading. I think paper trading, I mean, it's good. I'm not saying don't paper trade, but I'm saying, do it for a couple of weeks or a month, and then it's really all you're going to get out of it.
Yep, I agree.
The benefit kind of diminishes after that, once you get the feel of things, because it doesn't have that emotional aspect to it. So what I tell people is, once you paper trade for a little while, then go to the e-micros. That way, you're not going to be making or losing like your life savings in a week, but you will, even though it's a small dollar amount, you will start to get a hint of what the emotional aspect of trading is. So it's really a good way to start out, for sure.
Couple questions. Arbach is asking, on what spot exchanges does the CME offset its risks?
I'm not sure that the CME does, or I'm not even sure they really carry any trading risk, because the CME is really just matching buyers and sellers. They're not taking any side of the trade, so I wouldn't imagine that they would even have any need to.
Right. I think that there's confusion there on like a smaller spot Forex bank that does actually take your trade, and then they need to go offset. Right. They have to find somewhere to offset, whereas the CME, it's automatic. I mean, as soon as your trade is executed, it's already offset.
Exactly. Right. Yeah. We should clarify that. In the Forex market, you are most likely trading against your brokerage firm, where, like Mike just said, they do have some risk if they don't offset it somewhere. But in the case of the futures market and the CME, nobody is taking any type of trading risk whatsoever. Your broker's not, and the CME is not. All they're doing is matching buyers and sellers. So when you buy a futures contract on the CME, they're matching you with some other retail trader, or maybe it's a hedger. We don't know who the other side is, but it's another trader. There's nobody in the middle of that. It's just buyers and sellers together, and that's it. There's nobody taking a cut or skewing prices or anything like that. It's a pure marketplace.
Right. And then the last question that's up right now, Richard is asking, what are the costs of rolling to another month?
Okay, rolling is just a real, you know, futures brokers use it all the time, but it's really just a fancy way of saying getting out of one contract and getting into the other. So like, let's say, for example, we mentioned before that currency futures expire quarterly. Now, it's true that the CME will list contracts out, you know, a year or two in advance. So in theory, you could say, all right, I want to buy you know, June of 2015 futures and just hang on to it forever. But in reality, that it doesn't work that way. Especially with the E-micros, you're going to find that there's really, and even in the full-size contract, this is really mostly the case, the liquidity is really in the front month only. So you're pretty much stuck trading the front month, and that's not such a bad deal. It just means every 3 months you have to roll over, and like I said, that just means, let's say that we're long the December futures, and towards the end of December, we realized that we want to continue holding the position. It actually would probably be like early December, but anyways, if you want to continue holding the position, you'd have to roll into March. So what you would do is you would sell the December that you were holding, and then you would buy a March futures. So your only cost is really the commission, whatever the commission is that you worked out with your brokerage firm. That's your only true cost. You do want to keep in mind, though, that the December futures is probably going to be trading either at a discount or a premium to the March and so on and so forth. So you are going to, you know, for example, if you're, let's say you're, well, I'm just going to look and see what the March futures is right now. So like if you were holding a December futures contract, right now we'll just call it 134.55. And you were rolling into the March, actually there's not much of a spread whatsoever. The March right now is at 134.57, so you'd essentially roll over with your only cost really being the commission.
I just looked, but the volume is
pretty simple.
Like 600 contracts.
Yeah, you really don't, you wouldn't want to roll over yet, for sure.
I've seen,
and it's, like I said.
Yeah, sorry, I've seen on some commodities like oil, maybe not the currencies, but like on oil, I've seen decent liquidity usually in the December month, you know, for whatever reason.
Yeah, you'll find in commodities there is a lot more. I think it's because because of the hedging and all of those types of things. In commodities, especially like the grains and crude oil, you'll see liquidity several months out. In the financials, so treasuries, stock indices, and currencies, really there's only liquidity in the front month. If you try to go any further than that, you're just doomed. So stick to the front month in currencies, and it's not so bad if you have to roll over 4 times a year, 4 commissions. It's not that big of a deal. I mean, assuming that you're in the trade for that long. Most, even with an E-micro position trade like this, you're probably not going to hold on that long. But if you did, you know, it wouldn't be the end of the world, as far as costs go, anyway. So the idea is dollar cost averaging. I mean, you hear it all the time in your stock investment accounts, but you don't hear that a lot in futures because, quite frankly, most people just don't have the money to do that sort of thing. But we'll show you how maybe with the E-micro futures you could have maybe it brings a whole new strategy to mind. So this was actually a couple of weeks ago. We took this snapshot chart of the euro, when the euro was trading somewhere up around the 135.50 level. Now, a trader might have looked at that and said, well, you know, the 2-year high was just a little higher than we are now. So I don't know about you. I mean, everybody has different strategies, but my personality tells me if something's really high, I want to be a bear, or if it's really low, I want to be a bull. So someone like with my type of personality might look at this and say, well, with an E-micro, I could sell some futures here, or A futures, we'll start with one, with pretty low risk, right? I mean, if we go up and touch the 2-year high, we're talking maybe another 100, 150 points. In an E-micro future, let's just say 150 points higher, that your risk is like $200. So to me, that that seems like a pretty manageable way to start. And let's assume that as we're planning this trade out, we know that it's about a $200 risk if the market retests the 2-year high. We can take a look at back in October of 2011, the market kind of peaked out around 142.36. So if we really wanted to be in the euro for the long haul, we might say, well, we're willing to ride it all the way up to the 2011 fall high. maybe even add on a contract there. And at that point, we're talking about a $750 loss on the original, which obviously $750 is real money, and it stings a little bit, but it's probably not going to blow your account out. And at that point, you might be even more comfortable saying, hey, I'm going to put on another contract. Because now we're at 3-year highs, and I'm still bearish fundamentally. So in theory, if you really, really felt strongly about being bearish the euro, you could incorporate into your game plan that, I'm just going to be willing to ride this thing out to the April of 2011 high. And if this chart went back a little further, you'd notice that the all-time high is around 160. So it's honestly not that far under the all-time high. So you're talking about starting a scale trade that potentially, even if we got up to the highest price we've seen in 3 years, which is probably not likely, you're only talking about $1,600 loss on the original contract and $1,000 loss on the other. And again, I'm not saying that's not a lot of money, but if you've ever traded the full-size contracts, you would know that $1,600 loss on a full-size contract is like maybe a day or two.
Right.
So,
whereas this could take,
puts things in perspective.
Right. So, this could be weeks or months for this to happen.
This could be months, years. Yeah, this could take forever. So, and obviously you don't want to lose money, but if you did, kind of scale up, you'd be in a pretty good spot. I mean, being short 3 contracts from 150 in the euro, shoot, I wouldn't mind being in that position, even if you are carrying a little bit of a, some weight. And then in this slide, it gives you an idea of kind of what might have happened. If, let's assume that the market went all the way up to 150 and you were able to get that 3rd contract on, and let's say that the market peaked out, your break-even point is going to be at 142.60. So all the market would have to do was get back down to 142.60, which is still historically a very high price for the euro, and you'd be breaking even. If the market returned to the original price that you originally started selling, you'd be making $2,500 on a trade that honestly your risk, I mean, you can never say what your max risk was, because maybe the euro could go higher than 150. I highly doubt it, but anything could happen. So even though we were kind of saying our max risk was approximately 2,600, it's possible it could have been a little more, but with that said, hypothetically, even if the market only came down to where we originally started selling, meaning we were basically wrong right off the bat, you'd still make $2,500 on an E-micro. And to be honest, you probably wouldn't have been uber stressed out. I mean, it depends on your financial standing, but I would venture to say that most traders wouldn't have been ready to jump off the bridge with a $2,000 loss, and they know historically that the euro probably is going to have a tough time sustaining near all-time high prices. So the odds of something like this are pretty favorable. If, let's say that the trader sold around 135 and they were right off the bat and the market pulled back, if the market came down to the lower end of the range, somewhere around 128, it's a $1,000 profit, which isn't too bad for a margin of $275 or whatever it is. So this basically, all I'm trying to point out here is you can trade like the big boys with a very small account if you use the E-micros. I mean, this is what, when I talk about the big boys, this is what they do. They don't have to be right away. Like somebody in a small account trading a full-size futures, there's not a lot of room for error because the market moves so fast for you or against you. But what the big boys do, that have big, giant, sizable trading accounts, they can put a contract on, and if they're wrong, they put another one on. And in theory, they could sell their way out of being wrong eventually, assuming they didn't have any capital limits. So this kind of opens the door to that type of mentality for smaller traders. All right, we're going to talk a little bit about Forex and futures options, currency options, obviously. Currency futures options are standardized in regards to size and expiration. It's kind of like a one-size-fits-all type of thing. There's really not a lot of customization available. Forex options are much different. Forex options are much more customizable than the options on currency futures. but it's typically the client's brokerage firm on the other side of the trade, and there's a conflict of interest. So the reason, I guess what I'm trying to say there is the reason Forex options are so customizable is because you're not trading in a marketplace. You're trading against your broker, and you're basically saying, hey broker, I want to buy this option. How much would you charge me? And I want it to expire on this date, so how much would you charge me for that? And that's really essentially what it is. On an option platform in Forex, you'll see a button that says request for quote or RFQ, and all that means is, you put in your parameters. You want to buy this option, this currency with this strike price at this expiration date with any other customizable features, and then you hit that button and you're basically asking your broker, how much would you charge me for that option? Now in currency futures, it's a real marketplace. You can't ask for special attention or special customizations. It is what it is. Here's the option, here's the price. It's the price that everybody has to pay, and that's what it is. And again, I'll touch on liquidity. It's the same thing in the Forex options as it is the Forex market. The Forex options claim massive liquidity, but the aggregate numbers don't contribute to each trader's ability to enter and exit with ease. Most likely you are trading directly against your broker. There's only one counterparty, so he names the price. That's what makes it so questionable in my eyes. Is it's not, the market isn't determining what the price is, it's your broker, and he's the one selling you the option. So in a nutshell, although the mechanics of calls and puts are going to be reasonably alike across trading arenas, Forex options are vastly diverse from options on futures because there's competition. Well, I should say there's a lack of competition in Forex, and you can negotiate terms in Forex. So in my eyes, I feel like trading options in Forex, it's a little disheartening for me because I know that the person on the other side of the trade is my broker, and if I'm losing money, he's probably making money, and vice versa. You're basically trading against the house. And like I said before, he's the one telling me what the price of the option is. So it's hard for me to wrap my head around that. I'm used to trading options on the futures market where there's a little more of a level playing field. I believe the markets are more efficient, and I believe they're more competitive, which is probably going to lead to much tighter bid-ask spreads. So for example, if you're trading Forex options against your brokerage firm, he's naming the price. He knows that he's determining what the bid-ask spread is, so he's giving you a number based on what he feels his risk is. But in the open futures market, the bid and the ask is determined by market makers and any other competitive bids or asks. So in general, you're probably, not always, but you're probably most often going to see much tighter bid-ask spreads in the futures market than you would the Forex market on options. And with the customization of options, it really prevents the price transparency because think about it this way. Options in general are not nearly as liquid as futures or Forex. Like there's not nearly as many people trading options as there are trading the outright currencies. And there's a lot of reasons for that, and we won't get into that. But it's easy, so it's generally accurate to say that the liquidity in the option market is going to be less than that in the Forex or futures market, just in general. But in the Forex market, it takes it one step further because, again, you're trading against your broker, and so there really is no price transparency. He could, if you buy an option and the market goes your favor, you might think in your mind, that it should be worth X number of dollars, but the only price you can sell it at is the price that he tells you it's worth. So there's really not any price discovery, and there's no transparency at all there. Now, one thing that the Forex market has that the futures market does not in regards to options is exotic options. Exotic options have unconventional characteristics. They can be any option that is not vanilla. And what that means is vanilla options are basically standard calls and puts. You know, if you buy a call, it's the right to buy the underlying currency at a specific price at a specific date and time. That's a vanilla option. An exotic option might have additional features on it. It might say something like it's a call option that only triggers if the futures price gets to, or I should say the Forex price or the currency price gets to a certain level first, then the option kicks in. So there's an unlimited number of kind of factors that can be put into an exotic option. I'm by any means not an expert on that sort of thing. I've never really traded them. I'm just aware of them. But you know, that's probably the only advantage of trading Forex options over futures options, if it is an advantage, because I'm really not convinced that these, you know, option types are any more profitable than vanilla. And you know, but they do give savvy traders more choices. And just keep in mind that options in general, futures or Forex, they're priced to lose, which is why I tend to be an advocate of option selling versus option buying. But with that said, you know, just because an option has, you know, a lot more features to it, or it's a little more exciting, doesn't mean it's not priced to lose, because it is. So exotic options are a nice feature of Forex, but I'm not sure that it's something that's going to help you make money. Okay, we're going to talk about just a few tips and tricks on just general overall ideas in trading options and currencies. And this is true of trading options in any market, but I like to remind people of this. It's a good idea to trade highly liquid markets. It reduces the bid-ask spread, and which in turn reduces the transaction cost, because if you're paying a big bid-ask spread to get into an option, whether you're buying or selling, you're already behind the 8 ball. You're already, you know, in a trough, and you have to work your way out just to break even. More liquidity will increase the fill quality. Prevents being trapped in a highly volatile or emotional trade. If you do happen to get into an illiquid option market, sometimes if there's, you know, an unexpected move, I'm talking like flash crash or something like that, you might find yourself in a situation where there's nobody to take the other side of the trade. And if there is somebody to take the other side of the trade, you might have to do it at outrageous prices. So even if you get a fill, you might not be happy with it. One market that a lot of beginning traders like to look at is copper, and for whatever reason they want to try to trade copper options, but copper options are ridiculously illiquid. On average, and I'm not just saying some options, I'm saying most options have a bid-ask spread of like a penny or more. So we're talking like $150, $250 for the bid-ask spread. So if you bought an option, you're automatically losing a couple $100 just because there was nobody else really trading in the market. You're the only one there. And the market maker knows that if he sells that option to you, then he's going to have a hard time offsetting his risk. So he just charges you a fortune in the bid-ask spread. So stay away from illiquid markets. When it comes to currencies, there's just kind of, I'm not saying that you should never trade certain currency option markets, but this is a good kind of rule of thumb to stick to. The best environment for trading options and currencies is the euro, and that's really just because there's a lot of liquidity there. Other attractive markets are the yen and the British pound, although the yen earlier this year when the volatility was so high, and I'm talking like, I'm trying to think, I guess it was like the first quarter of this year when the yen was just crazy all over the place in free fall. During that time, the yen was not an attractive market to trade options. The bid-ask spreads were wide, the premiums were just skiwampas. I mean, it was really wild. But under normal circumstances, the yen's a pretty good option market to trade. British pound, it has pretty fair bid-ask spreads. The Canadian, the Aussie, and the Swiss are all very viable and tradable markets. You want to maybe tread a little more lightly in those than you would the euro. And I would recommend that you avoid trading any cross pairs, and this is actually true of the options and the futures. And when I say cross pairs, I'm saying pairs that do not involve the US dollar. There just simply is not enough liquidity there. If you're interested in trading cross pairs, then you know what? In that case, Forex is actually a better venue for you than futures. In the futures, you're really going to have a tough time getting fair fills. As a general rule of thumb, option traders are trading volatility just as much or more as they are price, and I try to enforce this in almost every webinar I do. These are very well-known and obvious facts about option trading, but it goes against human nature, and we all need to be reminded, because I'm telling you, the first thing that we want to do is buy back a short option when the market gets volatile, or buy an option after the market's already moved. I mean, we see it all the time. The S&P's down 40 points, and all of a sudden everybody and their dog wants to buy a put. That is the worst thing you can do, but that's human nature. That's what we all are programmed to do. So again, long option traders want low volatility. Buying an option after volatility is picked up really reduces the odds of success. You're basically overpaying for that instrument. Short option traders want high volatility. They want to sell an option selling an option before the volatility is picked up really reduces the odds of success. So in other words, it's like, as an option trader, it's like being a retailer. You really don't want to be the retailer selling your inventory off the discount rack. You want to be selling your inventory at high prices. In fact, you want people to pay more than the market value for those. And so as a short option trader, you really should be only only trading during times of high volatility and when it looks like the options are theoretically overpriced. I'm not a big fan of trading in the money options. Whether you're buying or selling options, I believe that choosing an out of the money strike reduces your risk. The opportunity cost is reduction of potential reward. So it's true, if you're trading out of the money options, you're probably going to, and you're right, you're probably going to make less money, but guess what? Most traders are usually wrong, and with that in mind, you probably want to work towards risk reduction as opposed to trying to hit a home run. Also, deep in the money options become super illiquid. The bid-ask are spread, or in some case they just disappear altogether. If you find yourself in the position of having a deep in the money option, whether you're long or short, if you want to get out of it but there's really no one to take the other side of your trade, you can actually trade a futures contract against it and just hold it to expiration. It locks in your profit or your loss, but it avoids you having to give up several $100s to try to get out of the option. So this is just a real quick example of what I'm talking about, of higher delta equals higher risk and reward. If you're trading an option that's deep in the money, you'll notice in this case the euro is trading approximately 130, and if you look at the 123.50 call, which is about 7 handles in the money, which is pretty substantial, the delta is 90, which means it's almost like trading a futures contract. You will find a lot of option traders trade these options. They'll buy and sell them because they feel like they get a lot of bang for their buck. I mean, think about it. You're buying an option so you have limited risk, but it's probably going to move almost as fast as the futures market. Remember, a futures market has a delta of 1. So if you're trading an option that has a delta of about 90, it's basically like having a futures contract. With that said, you're going to pay a fortune to get into that option. And if you're an option seller, people look at that premium and they say, wow, that's worth like $8,000. I'm going to sell that. But the truth is, it's all intrinsic value. It's not time value, it's intrinsic value. So you're really not doing anything other than trading the futures market when you trade options that deep in the money. And to make things worse, you're probably going to have a hard time getting in and out of it. Here's an example of that. Deep in the money strikes are too illiquid to trade. In this case, the 128.50, which is only about 300 points in the money, you'll notice it has a bid-ask spread of about 8 ticks. that's not so bad. That's not the end of the world. But if you look at the 127 or the 127.50, there's no bid or ask at all, and that's not because there's something wrong with the quote board. That's just because the market maker says, forget it, I'm not willing to trade in that option. So you can put a price in, and he may or may not take it, but there's really no market for it. So there's no reason for you to be trading in the money options, because you might find yourself in a position like that where you can't get out of it. And if you do find yourself in that position, like I said, you can trade the futures around it. Hopefully your broker can kind of wait and help you through that. And when you're trading options on currencies or any other market, you want to look at strike price and you want to look at premium, but it's just important to be aware of the underlying futures price. Like a lot of people will say, well, I want to spend $300 on an option, or they'll say, I want to collect about $500 on an option. So they go shopping for options based on the price. But in all actuality, what they should be doing is looking at the chart and determining, whether or not it's actually a good deal or not. Short options should be positioned well above or below support and resistance, and long options really should only be implemented once if the price is right. If you overpay for an option, you're dead meat. So you want to buy options when, like for example, you want to buy calls when a market's oversold, or puts when a market's overbought. This is my opinion, of course, but that's exactly when most people don't want to do those things. And the reason being, if you buy a call option after a market's already moved up, the calls are already overpriced. So even if you're right and the market continues up, the chances of you making money on that are very slim. Timing is everything in options. It's true of futures too, obviously. Timing is everything in any type of trading. But particularly in options, because options are priced to lose. Whether you're buying options or selling options, you really need to know that. And because options are priced to lose, that's why we tend to be option sellers. Now, it's not guaranteed money. Just because you sell an option doesn't mean that it's gravy train to the bank. It's not quite like that. But the idea is you want to put the odds in your favor. So what we do is we look at just technical oscillators, the RSI and the percent R. You'll notice over here, and this is just general. It's easy to take a step back and look at things after the fact, obviously, but as you're trading and throughout the day, I want you keep in mind that you don't want to buy into the hype. If everybody is bullish the euro, then maybe it's time to turn the corner. I mean, I'm sure everyone remembers a couple of years ago when the euro was selling off, and in fact, I think it was somewhere in here, the euro's at 126, and I remember people talking about the euro not existing in a year, or the euro being under par in a couple of months. And of course, when you turn on the TV and that's all you hear about is everybody's thinking the euro's going to heck in a handbasket, that's usually when the trend is about exhausted. And so this is the time where you either want to be buying calls or selling puts. The last thing you want to do is sell calls after a market's been selling off like this, because quite frankly, you're selling them at a discount. You're selling them cheap, and if something does happen to turn the market around, that cheap option will get very expensive very quickly. Okay, well, I appreciate everybody attending. Hopefully you learned a little something that maybe you hadn't thought of before. And if you're interested in learning more, as I mentioned before, currency trading in the Forex and futures markets covers this in much, much more detail, and probably is a little more organized than my rambling. Here's all my contact information, so if you have any questions, feel free to send me an email or give me a call. Again, check us out on Facebook and Twitter.
Hey, Carly, I really appreciate you taking the time to put the presentation together and to answer everybody's questions. And actually, there's just a couple questions up, and then we'll let everybody go home. Sal is asking, what kind of volatility does futures options expiration have on the underlying futures contract? Should one expect high volatility on expiration day?
I'm sorry, can you repeat that, please? I'm sorry.
Yeah, Sal's basically asking if there's any type of volatility on options expiration on the underlying futures contracts. Like, is there higher volatility on expiration day?
Okay. It's hit or miss. Some expirations you see the market is basically pegged and does absolutely nothing, and then other times you see really wild moves. There is actually a currency option expiration just recently, and sorry, I'm just trying to pull up a chart in the euro. If you remember that big down day about a week ago, that, in my opinion, that was a large part due to option expiration, and it's just one of those things that if there happens to be some sort of event going on it's surrounding option expiration, yes, you can see some pretty wild moves, and a lot of it being, for example, in that move about a week ago with the euro, I'm pretty certain that a lot of people had short puts. That's just unfortunately the nature of the market. When the market's in an uptrend, people think it's going to go up forever. When it's in a downtrend, they think it's going down forever. So what happens is a lot of people trading options with the trend will sell options. In this case, they were probably selling puts all the way up. And then when you do happen to get that big down day, which doesn't necessarily happen on a high frequency, but it only takes that that one day to really throw things off, then all of a sudden all those people that were short puts are selling futures to try to compensate, and it just ends up being a big washout, and that's what we got last Friday. So the answer to your question is, unfortunately we can't see it in advance, but what I like to do is if I see that a market's really moving on option expiration day like that, I like to take that as maybe an opportunity that, hey, this is a market that's flushing out and is probably putting in some sort of short-term low, if it's flushing out to the downside, or if it's a big short squeeze, maybe a short-term high. So I, being the counter, the antagonist, I guess, that I tend to be, I look for big moves on option expiration like that to potentially start shopping around for short options to sell against it. Because a lot of times, like I said, the expiration kind of exaggerates everything, and then the next week the market will bounce back to a more equilibrium level.
Okay. All right, guys. Since we're already running long, I'm going to just say that if anybody has any further questions for Carley, give her a call or send her an email. And I'll also be posting the recording of this on BMT sometime tomorrow. So thank you, Carley. I really appreciate it. And we'll see you again. Thanks, guys.
Okay, sounds good. Thanks.
All right.